Well, hello everybody, and welcome to the Oil and Gas Retirement Planning webinar. I am Kerry Facer. I will be your moderator today, and with me on this call, I have Justin Rucci, Certified Financial Planner, Emily Balmages, Certified Financial Planner, and Lynn Hansen, our local resident Chevron expert. Let's begin. Real quick, we have some disclosures here, so if you want a copy of our ADV, please reach out to us, and we'll make that available to you. Today we're going to be talking about our steps for a successful retirement, and we have the 8 steps here. And without further ado, we're going to jump right in. But before that, a fun little icebreaker here. So first person says, we're in a recession. It may be a smart time to buy. Buy, are you leaving? Did you get fired? Layoffs, this is so depressing. Depression, we're in a depression. Finally, the last person says sell. We hear this all the time, and specifically for Chevron, when to buy or sell Chevron stock, and it's been a difficult time to get the water cooler talk in, everyone working remotely, but hopefully today we'll cover that with you. If you have questions, we did feature in the invitation to the webinar today, we have a spot to discuss open enrollment. So as we're going through these items and you have questions about your benefits, open enrollment, maybe it's retiree medical. We do again have Lynn Hansen, who worked at Chevron for 20 plus years and is retired and a financial planner with Warren Street Wealth Advisors. That is Lynn, second from the right. And again, with me on the call today, I have Emily and Justin. You're both there. And let's get actually Lynn on here real quick. Lynn, if you're listening, we'll have you unmute and join via video. And let's take a look here. So we have steps for successful retirement. First one here, number 2, is read a retirement handbook. And to cover the retirement handbook, Justin Rucci, CFP, and one of our lead relationship managers, is going to help explain what this is.
Thanks, Kerry.
Absolutely.
So I'm just going to quickly run through this handbook. As a reminder, this is something we have available in PDF format. So if you want to have this after the fact, don't hesitate to reach out to us and we can send you a copy. The first 2 bullet points on the handbook go hand in hand is making sure you have a plan to begin with. So one of the things we will talk about a little bit later is we commonly see people procrastinate, but by joining this call, you're already one step closer to having a plan. Number 3 is making sure your retirement timing is correct. This is particularly important this year with all the different things going on at Chevron, but even without that, timing your retirement can be dependent on how much PTO, vacation time you have, when you get your bonuses, and what tax bracket you're in and might be in retirement. So that's something you want to be thinking about when you're planning for retirement also. Number 4 is just kind of a reminder that just because you're not the IRS typical retirement age of 59.5 does not mean you can't retire. We have people go sometimes as early as 55 or anywhere in between, so we can certainly make that work without incurring any early withdrawal penalties if needed. Number 5 is budgeting for medical expenses. So this one is something you definitely want to pay attention to, because medical expenses, especially if you retire prior to age 65 or Medicare age, can be higher in retirement. So it's something you want to make sure you're adding back into your budget as a expense item that you're not currently probably planning for right now as it comes out of your paycheck. Number 6 is say goodbye to credit card debt. Probably self-explanatory, but you want to try and clean up your balance sheet and get as much debt paid off as you can prior to retirement. And number 7 goes hand in hand with that, is once you have the debt paid off, the next logical step is to build up some emergency savings. The general rule of thumb is to try and get to around 6 months worth of expenses as cash reserves. Number 8 here is keep a budget. So unless you know how much you're going to spend each month, it's very difficult to be able to plan for retirement. We're going to cover retirement budgets a little bit later in the presentation, but that's a really important step. Number 9 is knowing your options on Social Security. Emily's going to talk about this a little bit, but basically it boils down to being able to take it as early as 62 or as late as age 70, with most people's full retirement age somewhere in the middle of 67 or 66. And number 10, invest for retirement. This means taking advantage of your 401k, staying diversified and not entirely in company stock, and just making sure that you're using all the avenues available to you. The next item on our agenda for today is to go over some of those common roadblocks, which I alluded to a little bit already. I'm actually going to pass it to Emily, and she's going to go over these items.
Okay, hi everybody, great to be here today. I'm going to quickly run through some very common roadblocks, and if any of these are relatable to you, don't feel bad, you are not alone. Number one failure to plan, you're going to hear us say this again and again. And, we know that life happens, plans will change, things will change, but just getting that initial structure in place can be very helpful. And, I've seen clients completely change their saving and spending habits once a plan is in place, that initial plan. And, running some projections, seeing what saving today can look like 20 or 30 years down the line can be very motivating. Second item, lack of financial knowledge, also very common. There's a lot to know and rules change all the time, especially tax law. So this is where partnering with a trusted financial professional can really help steer things in the right direction for you. Rising prices, AKA inflation. This is a big one, even, in this kind of lower inflation environment, just 2% increase in costs a year can have a big impact on a retirement time, 30 to 40 year retirement time horizon. So you'll just want to make sure that any projections and any plans include an inflation component. Tax burden, we all know this is inescapable, but there are some powerful strategies to reduce your tax burden. And certainly a lot of those strategies are more powerful the earlier you start. And finally, procrastination, we can all relate to this one to some extent. Many people find financial planning, tax planning topics to be confusing, intimidating, and certainly boring. So a lot of times it falls to the bottom of the list. So this is, again, where, partnering with a trusted professional can help you kind of keep checking those items off the list and keep them kind of front and center, as your days go along. And we thought we would just touch on some high-level Social Security concepts. Certainly, every situation is unique. We would want to talk to you individually before providing individual recommendations. But Social Security strategies are on people's mind as the retirement horizon is approaching. You are probably aware the ages to claim retirement benefits are between 62 and 70. You can collect while you're working, though. If you have not reached full retirement age, your benefits may be reduced. So you'll want to kind of run those numbers and look at that. Full retirement age, they define as either 66 or 67, depending on the year in which you were born. Anyone born 1960 or later is squarely in the 67 full retirement age category. Waiting until 70 can pay off. You are probably aware that you can receive what's called a delayed retirement credit of 8% a year for every year you delay between full retirement age and 70. So that can be a powerful addition to your benefits, between 24 and 32% increase in benefits. And so it's something that you want to consider. Spousal benefits, there are strategies when you have spouses, especially, either both with earnings records or perhaps only one with earnings records. There are strategies that can be implemented. So you just want to kind of pause if you're married before either of you claim, and be sure you look at the kind of various strategies available to spouses. Underlying all of these decisions are health and anticipated longevity. So if you have a sense of either, longer than average longevity, or there are some medical conditions and maybe shorter than, average longevity, that will factor into the decision making here. And then finally, is Social Security going away? That certainly the system faces many complex problems, and but the good news is there are solutions to those problems in the form of legislative solutions, either in increasing revenue or decreasing benefits. We do think that these legislative fixes will happen eventually. It's been a very successful program, helped a lot of Americans. So we don't think it's going away. We do think ultimately there will be some legislative fixes to keep the program strong and going. And now I'm going to turn it back to Justin to move us along our steps for successful retirement.
Thanks, Emily. So the next quick section we're going to go through is just some basic investment tips. The first one is probably straightforward as it gets, which is save. And it's also the thing that you kind of have the most control over, which is how much you're putting away each month. Second one is not just putting money away, but stuffing it under the mattress, but actually being willing and able to take on some smart risk with that. Smart risk is really defined by number 3 on this list, which is diversification and not having all your eggs in one basket. Number 4 is taking advantage of the tax code. So I'm going to go into a strategy that you can do at Chevron in the next couple slides called the Mega Roth, which is really taking advantage of the tax code to the fullest extent. Number 5 is rebalance. We frequently see individuals set up their 401k when they first started a company and then never do anything with it again. Rebalancing is actually a really important step that can end up getting you higher returns over time. So that's something that we do for our clients and something you certainly want to do for yourself if you're not doing so currently. And lastly here, think contrarian. Think back to that cartoon Carrie shared in the very beginning. A lot of investment tips that go around on hearsay or water cooler talk, a lot of the times are not the ones you want to be getting involved in. Many times the best investments are the ones no one's talking about. So I'm going to jump into the backdoor mega Roth tax strategy. I will preface this by saying I'm going to go through this quickly. It is a very complicated item, so if you have any follow-up questions on this, we're happy to talk one-on-one after. This is something we do for clients all the time. So in 2020, you may or may not be familiar with just the standard contribution limit, which is $19,500 or $26,000 if you were at the age 50 or older. There's also a second 401k contribution limit that many people don't realize exists, which is a total contribution limit. And this is what you put in, what your employer puts in, and then also what you're able to put in on any after-tax basis. 2020, that limit is either $57,000 or $63,500, depending on your age. Now, there is a difference between after-tax and Roth. So this is a common question we get is, okay, if I've done my maximum $19,500 or $26,000, and I can contribute after-tax beyond that, what does that exactly mean? So after-tax means that you're not getting a current tax deduction for your contribution. The monies will grow tax deferred, so any dividends or interest you get while it's invested is not taxable in the year you get it. But when you take that money out, whatever earnings you've accumulated are taxable with an after-tax contribution. That's not the case with Roth. In Roth, all those earnings that you accumulate when you take the money out are tax-free. So obviously, if you have the choice between the two, you would take the Roth. The difference is the after-tax is the only one that's available once you hit that initial $19,500 or $26,000 limit. If we go to the next slide, I'll run through an example here of if you're over the age of 50, you make $100,000 a year, and let's assume you're a really good saver. So you're maxing out $26,000. Now this is either from pre-tax Roth or a combination of two. Those are your most tax advantaged contribution types. You're getting an $8,000 company match. That leaves from the total limit of $63,500 another $29,500 that technically you could add to the 401k before you hit the total contribution limit. And the IRS says that you could do this on an after-tax basis. So again, you won't get a tax break, but the money will grow tax deferred, and you can continue to push money into retirement on a tax advantage basis. I will quickly say that this is not something you need to be 59 and a half to do. Anyone at any age at Chevron can do this. Now, where the benefit really comes in is rather than have after-tax dollars sit there between now and retirement, is the IRS actually lets you convert those after-tax dollars to Roth. So while you can't do a direct Roth contribution once you've hit the main limit, you can do an after-tax and then convert it to Roth after the fact and essentially get around that contribution limit. This chart shows what happens when you do that. So if you contribute, in this example, $40,000 of after-tax, it is now worth $50,000 with the investment growth. Your $40,000 will go into a Roth IRA. Your $10,000 of earnings will go into a traditional IRA. And then from that point on, your 40 will grow tax-free, your 10 will grow tax-deferred, and you will have paid zero tax for doing that conversion. You also have the option to just convert the whole 50 to Roth and then pay tax on the 10 up front and then never pay tax on it again. But we see people typically will roll to the traditional IRA unless the amount of earnings are negligible. So the next item on our agenda is to talk more about your vision for retirement. So I'm actually going to pass things back to Carrie. He's going to talk about some of the lifestyle decisions that go into planning for retirement.
Yeah, thank you, Justin. In the 14 years I've been doing this as one of the founding partners of Warren Street Wealth Advisors, I found myself more and more interested in, as far as not planning for retirement, what our clients are going to be doing after retirement. So one thing I share with the team often is to make sure we are reminding our clients why we work so hard and why we've saved all this money and why we're doing Mega Ross and why we're attending these webinars. Is our goal is to see our clients, transition successfully into retirement once with a ton of confidence. And with that comes this new idea and this, new beginning of what now. And so what we'd like to talk about is, what are you going to do now with this new time that you have? And one of the most common things we hear is move out of state. And so I'm going to talk about that in a moment. Before we do, just start thinking now about what it is you're going to do. Is it hobbies, more time with family, travel, sports, learn, volunteer, and try to get some clarity there, because all the money in the world is great, but if you can't do anything with it, what's the point? And we want to encourage and inspire our clients to finally take some time to look at exploring new ideas for this new chapter. So where you live, this has been interesting. In our live events over the years, I've found this topic to be more and more of interest to our clients, is moving out of state. And I'm sure there's some people on the call here. Anybody wants to throw out some of the states they would like to live in or they plan on retiring in, you can do so in the chat feature. But where you live is important to think about, because the cost of living hopefully will go down if you move out of the state of California, or at least out of SoCal, or the El Segundo area. And there's no surprise here in the top right that a lot of the most expensive metro areas are in California. And if you see this map here down there in the lower left, you can see SoCal in the bright red. And so when you think about moving out of state, though, one thing we want to be mindful of is not necessarily the lowest cost of living in the lowest state income tax rate, but is the weather and your relationship. So it's really a three-prong approach. It's the financial aspect of moving out of California, the cost of living, and state income tax are the two big factors that our clients are usually excited about. And in the second and third part are just as important, is where the relationship's going to be. So your friends and family, and then finally the weather. The weather is one thing we've seen clients in the past not do enough research or homework on. So we've learned from that, and now we encourage our clients and anybody listening is to go live in the state or the city specifically you want to for an extended period of time, 2 to 3 weeks, and or do that same period of time during the winter. The winter months in some of the states are very different from what we have here in SoCal. So we just encourage you to do that. Life expectancy is increasing. So the great news here is the life expectancy in the US is rising. It's finally starting to flatten off. This chart goes out to 2016, but in 2018 is the first year that it actually stopped increasing. And it's holding, but the good news is we live a long time. So we start thinking about this, is retiring at age 55 is the primary goal for the majority of our clients and people attending our workshops. But the reality is, if we're going to be if we're healthy at age 55, we're going to be living to be in our 90s, then we have to plan to have enough money for the next 35 to 40 years. And so it's just one thing to consider when we do discuss this with you, is we don't want you to work forever. We want you to retire. That is our goal. Is our primary concern is to get you retired, but to do it with confidence and clarity and honesty. So we just need to plan to live a long time and make sure we have enough money to do so. Today might feel like this, hopefully it doesn't, but I can imagine that planning for retirement might feel like this poor woman sitting in front of all of that paperwork. So to help bring some clarity, Justin's going to talk about the retirement toolkit.
Thanks, Gary. So the retirement toolkit is another PDF that we have. So if you want a copy of this, we can get this sent out to you. But it's basically comprised of two main components, which are the two most important things you want to get together as you begin your retirement planning. The first one is your net worth scorecard. So what we've done is we've really created a template here to try and make this as easy as possible, compiling all your assets, all your liabilities. The goal of this is at the bottom there to basically total up all your assets and subtract your total liabilities from that number, and that'll allow you to arrive at your net worth score. This is really the main step in just getting a good feel for what your current financial picture looks like. Like I kind of alluded to a little bit before, though, you could have a $10 million net worth, but unless you know how much you're going to spend each month, we can't tell you whether or not you're going to retire. So the second piece of this is the same concept, but for a budget. So we've created a template with all the main categories that we frequently see. We've added some options on the end there for anything that doesn't fit into these categories. And this is designed to allow you to spend 15, 20 minutes. You don't have to get down to the penny here, but just get an idea of what your monthly expenses are on average. And so if we have a good feel for what your net worth is, what your assets and income streams are, and you have a good feel for what your expenses are each month, those are the two main things, and obviously more goes into it, but high level, those are the two main things that we really need as planners to be able to figure out whether or not your retirement timeline makes sense. And so this is the main starting point. If you're starting to think about retirement, definitely something you want to get together and work on. Number 7, next steps. So I'm going to actually pass things back to Kerry, and he's going to go over what some of the next items you want to be thinking about are.
Yeah, and real quick for anybody who's listening, on the toolkit and even the handbook, we have both of those available in PDF format. So if you would like a copy of those, just go to the chat section and just say, send me a copy. We have your registration information, the email you provided, so we will just send you a copy after the end of the workshop if you want those in PDF format. And they might look a little underwhelming, but the reality is that's the nitty-gritty work to really get started with retirement, is the toolkit and the handbook. Specifically the toolkit, those two items there, the budget and the net worth scorecard. With those 2 items, we can look at those and give you some quick feedback as far as being, what we feel on track or off track with your current goals and objectives. So thank you for that, Justin. So as far as next steps, we are very transparent in our pricing. This is our fee schedule. 401k Assist is a program we do for your 401k at Chevron. We'll build you a custom portfolio allocation, help you either get back in the market or maybe reduce risk, help you sell your Chevron stock. And while we're all talking about Chevron stock, don't sell your ESOP shares. Lynn, if you're there, you could probably chime in well on this as well. I'll give you a second to unmute. But we've seen in the past clients sell their Chevron stock, and specifically they sell the ESOP shares. And what we don't want to do is see you sell ESOP shares. Instead, we recommend selling the common shares. Lynn, there you are. Yeah, let everybody know what you've seen in the past as far as that goes, because last call you mentioned that, and I think that was a surprise to some of the listeners.
Yeah, so Vanguard had a program, Fidelity has the same program where they'll manage your money for a fee. What I've found is they'll go in and sell your Chevron stock. Let's say you tell them to keep 20% Chevron in the portfolio, they'll actually sell the ESOP shares, which are, tax advantage. And if, what you'd like to do is, if you're going to drop down to 20%, we want all those regular common shares to be sold. But so I would be careful. If you've already signed up for it, not much you can do. But if you ever think about that, think again, and maybe reach out to us and we can explain the pitfalls of it.
Yeah, that was great. Thanks for sharing that again, Lynn. And so the 401k Assist is a way to have us build a custom 401k allocation for you and monitor it for you. And we can do that through that program. And then if you wanted a comprehensive financial plan that would start at $1,200, and that would include the $400 from above. So an additional $800, you get a comprehensive financial plan. And that's built by our team. And again, we have 2 certified financial planners on the call with us today. And we're taking our core team, all the years experience in building that plan for you. Investment management, so there's our fees. One thing I do want to show though is what we've been doing a lot over the last few years. We started this program called the Friends and Family 5, which allows bundled group pricing. So the fees above are the same, 401k Assist, same, financial plan, same. But on investment management, we knew Vanguard was charging around, I think, 0.7, 0.8%, somewhere in that range. And we are a small local firm, and we take really good care of our clients. And it's difficult for us to compete with Vanguard on price. We just don't have the marketing budget that they do. So we came up with this program instead. And the way it works is if you have up to 5 people in your friends and family, and let's just for easy math, everybody had $1 million, your average price for investment management would be 0.83%. And so that was a way for us to allow our clients and their friends and family they work with to do group bundled pricing. Nobody sees anybody's accounts. It's all on the back end, but it allows us to stay competitive with Vanguard and allows you to participate in that reduction of fee. And this is my professional opinion. I think we're way better than Vanguard. So our process, wealth design. Establish 1, 2, 3, 4, 5, 6. This is our planning process. The first meeting is free. Establish, it's a meeting for you to schedule with Lynn, myself, Justin, Emily, or a combination of us. We don't care who you meet with. We just want you to have an opportunity to talk to us. And if you decide to move forward on a financial plan, we carry all those steps out. And we do that for an entire year of service. In the back end of our systems, we're big on tech. Sure, we have a lot of judgment and we can give you advice off the cuff pretty quick. but we do rely on data and systems to give us the recommendations that we come together with. Investment improvement process. So if we were to manage some money for you, maybe you have some after-tax money in your 401k, and we've seen anywhere from $5,000 all the way up to $100,000. There's an opportunity with the after-tax money to move that over and take advantage of that as well, kind of like what Justin was talking about with the Mega Roth. So if you have after-tax money, that's something that you should talk to an advisor about, or us. We invest 3 core portfolios: a global stock, a global bond, global real asset, based on our core principles at the bottom. And that's what we do there on the investment management side. So Justin has a little kind of bonus piece here. We get asked about this all the time with financial engines selling all your common stock and your ESOP shares, like Len mentioned earlier. If you still have your ESOP shares, Justin's going to talk here how you should handle those.
Yes, thanks, Carrie. So one of the common things we see is individuals will come to us and 100% of their 401k will be in Chevron stock. And the reason it's a concern to us when we see that is we see somebody who's already relying on Chevron for their paycheck, their health insurance, their 401k match and pension, and then they also have all of their own savings in Chevron stock. So you think about all those things that are reliant on the performance of one company, it's really almost your entire financial picture outside of maybe your house. And so that's obviously a concern, and years like this year really put this into perspective for a lot of people. But even in good market years, it's something that you want to be aware of and diversify away from. So in terms of action items, like Glenn already alluded to a little bit, is you want to review what you have in ESOP versus what you have in common. Because of the two, the ESOP shares are the ones you likely want to keep, and the common shares don't have any special tax benefits to them. So if you're going to sell Chevron shares, you certainly want to start with the common shares. That's frequently what we do for a lot of our clients is we will get, eventually, we don't do this all at once, but we will eventually work our way down. So maybe there are no common shares left and the only remaining Chevron shares are the ESOP shares, which we can then use the net unrealized appreciation, or NUA, tax strategy on. Everything else gets invested into an asset allocation plan that we build together. Here is a graph that kind of illustrates what the advantage of the ESOP is. So the bar graph on the left, that's just a solid blue, that illustrates if you either sold all your ESOP shares or you just don't take advantage of the strategy, which in many cases, if you don't have an advisor, people kind of miss this one. If you, assuming don't take advantage of it, 100% of what you take out is going to be taxed as ordinary income, which is the same way your wages are taxed. If you take advantage of this strategy, what you can do is you can pay ordinary income on your basis for the stock, which is usually a very low number, and I'll let Len chime in when I finish this point. So you'll pay a little bit of tax up front, but in most cases, the vast majority of the account value is actually appreciation on the stock. And so that green bar is usually a much larger piece of the overall picture, and that you'd actually pay long-term capital gain rates on when you sell the stock. And so long-term capital gains rates for most people is 15%. If you don't have any other income, it could potentially be 0% federally. So case by case, of course, but in most cases, you can end up saving a little bit of money on tax. Len, if you want to unmute yourself and explain what the cost basis of these shares usually are. I know it's usually somewhere in the teen range.
Right. I haven't seen anybody over $18 a share. So the cost basis on your shares are 18 or below on everything. So you can see the difference between 18 and where we at 72 today is a big number.
Right.
That's
all I got. So we can jump to the next slide. We have a little bit of bonus material for you today. So in addition to the ESOP, I'm going to quickly just go over what the CARES Act was. So the CARES Act was the part of the stimulus bill that was passed in the first half of this year. And there were some changes that were made to retirement plans. So I'm going to quickly go through this. Again, keep in mind, this is a multi-100-page bill. So I'm trying to condense it down to as straightforward as possible. The first one is 2020 RMDs, or required minimum distributions, are waived. So this is anyone on the call, chances are you're not over the age of 70 and a half. So this mainly applies if you have any inherited IRAs. You do not need to take a distribution from that account this year. Number two is you're eligible to take a coronavirus-related distribution from an IRA up to $100,000, and they will waive the 10% penalty. You also have the flexibility to either pay the tax on that distribution, because it is still taxable despite not being a penalty, over the 3-year time period, or you could even potentially pay it back into the account within 3 years and pay no tax at all on it. You have the option to pay it all in 2020 if you do want to pay tax on it this year, but in most cases it'll make more sense to spread it over 3 years. This provision also applies to 401ks, and it also applies to 401k loans. So you can now borrow up to $100,000 from your 401k, which is up from the previous limit of either $50,000 or 50% of your account balance. The one fine print on here is you must be impacted by the virus or have a family member impacted by the virus. Does not mean that you physically caught it, but could also just mean that you were financially impacted. It's very vague, so it's probably likely that you could qualify for this if you need to. I will just say though, just because you may qualify for this does not mean that you should do it. I would consider these kind of a last resort. If you need the funds, it's available. Otherwise, I would avoid. The last kind of bonus we wanted to cover is it is now open enrollment season at Chevron. So open enrollment actually started yesterday. It goes through the 30th of this month. This is your once annual opportunity to change your healthcare. So if you are interested in changing your healthcare plan for 2021 and you want to switch to a new plan for that calendar year, this is your time to do so and review the plans. The one exception to this is if you have what is called a qualifying life event in the middle of the year, which is usually either somebody in your family gaining or losing coverage. It could be, having a child or something along those lines, getting married. That is considered a qualifying life event, and you can change your plan at that point. Otherwise, this is your one opportunity to do so. I know, Len, you were thinking about potentially changing your plan for 2021. So I don't know if you have anything you want to add from this, but certainly if you want to review the plans together, we're familiar with the concepts for high deductible plans and PPOs, HMOs, et cetera.
Yeah, so I got a little bit to add here. So I was just in the portal this morning looking at my plan, and I just highly recommend that you go in, even if you're not going to make any changes. If you don't make any changes, you keep the same plan. But I highly recommend that you go in there and take a look, because I noticed something today that I thought I had fixed last year, and I caught it this year. So even if you're not going to make any changes, go in there and take a look and see if everything is what you think it is, and you're not spending extra money or possibly have somebody on your insurance that shouldn't be there any longer, something like that.
Appreciate that, Lynn. Yeah, that's a great point, is get in there and just look around and make sure everything looks right at minimum. Go in there, explore your benefits. Any questions, let us know. And if you want to book a free consultation, like we mentioned in our planning process, book a free 30-minute retirement consultation, your chance to discuss any of your real retirement concerns with us. So you'll actually be talking to one of us. And if you just go to warrenstreetwealth.com/schedule, my recommendation is you start with Lynn. Lynn worked at Chevron for 25, 26 years. He still has access to his portal. He knows the benefits. He knows ANUA. He knows ESOP. He knows all those ins and outs. And then anything beyond that we've discussed together as a collective, we are here to support him and our clients. And so you can book that through our website /schedule. You can give us a call. You can even text that number. We do respond to texts. Again, we're a small team of 9. We take great care of our clients, and we hope that we can help you as well plan your retirement and transition into retirement with a ton of confidence. So we want to thank you all for attending. And the last item is, if you want a copy of the toolkit, or if you want a copy of the handbook, just shoot us an email, give us a call, and we're happy to provide you a copy of those free PDFs. Thanks again for attending, and we look forward to talking to you all real soon. Bye-bye.